Thanks for tuning in to the October Wrap. My name's Jessica Amir. Well, the global picture is indeed getting clearer, and today we're going to cover what that means for you. Plus, we'll wrap up how the ASX and Wall Street closed off the month with plenty of massive gains yet ahead. We'll also look to the ASX gainers and losers and see if there's any takeaways. Plus, we'll cover what to expect next in terms of economic news and also what's in store for markets next month and over the coming quarter. We'll also look at your portfolio positioning as the economy slows. But first up, over to the US. We saw the Federal Reserve cut rates as expected by 0.25%. And their economy ticked ahead, growing more than expected, rising 1.9% in the third quarter, beating the 1.6% expected climb. It was a slight drop, though, compared to the prior readings, 2%. And in terms of the China-US trade talks, well, they are progressing and ticking along as well. Phase 1 is still progressing, not really signed, sealed and delivered as yet. And so far, so good until just recently. We saw, in fact, in the last couple of days, President Donald Trump has come out allegedly demanding that China buy $50 billion of US farm products, and this seems to be an obstacle in the fresh trade talk debate. But what happens remains to be seen. Stay tuned. Staying in the US, we of course saw the trifecta of rate cuts, and comparisons are already being drawn to what we saw in the 1990s, where we saw the Fed slash rates 3 times in both 1995 and 1996. And in 1998, and those rate cuts successfully prolonged expansion. That also saw the S&P 500 and the Dow rise 21% and 24% respectively on average on the first year after the cuts. And the Nasdaq chimed up almost 40%. So it'll be interesting to see if history does repeat itself, which it often does. And in Europe, on the 12th day of Christmas, Bojo gave to me the first December election since 1923. Brexit is now also looking clearer, thanks to the UK PM Bojo's hopes that the election will give him a fresh mandate for the Brexit deal and break that parliamentary deadlock that we saw earlier, which of course led to the UK's extension to the Brexit being delayed to the 31st of January. Well, what else? Now we know for Australia, the RBA won't be cutting rates next week, as this week we saw the CPI rise 1.7% per annum as expected, moving towards the RBA's target range for inflation. And we can expect another cut potentially in December or February, taking the cash rate down to the 0.5% that the market is expecting. Well, what have the markets done for October? Well, Australia succumbed to the October effect, losing about 0.7%, pushing us now to sit within a target range or a line of sight that's 2.2% off our all-time high. However, year to date, things are looking positive. We're up almost 20%. Over the last couple of days, we took a bit of a step back. Today, or Thursday, in fact, the first of the Big Four reported. That was ANZ. It spooked and dragged down the market. What we can expect over the coming days remains to be seen, but don't forget Macquarie's results are due on Friday. Bell Potter's hoping to upgrade the stock to a buy. The next of the major banks report next week. In the United States, what happened there in terms of October? Well, it looked much brighter than Australia. The S&P 500 up 2.5%, and the S&P 500 closed above 3,046 for the first time in history. Tiffany & Co. shone brightly, up 34% in the month. So far, over 74% of the largest 500 companies have beat market expectations in terms of their earnings. The Dow was up 1.1%, while the tech-heavy Nasdaq shone the brightest, almost 3.9% higher, with a company called NF Energy Savings Corp chiming up a massive 333%. Diving back to our market, the tech sector was the most unloved, falling 6%. But of course, year to date, it has been a stellar performer. while we saw the healthcare sector inject the most life into the market, and that rose 5%. Moving to the ASX 200, one of the best was Clinuvel Pharmaceuticals, up almost 27% after announcing at the beginning of this month that it got the US green tick, the FDA approval for their photoprotective drug to treat a rare light disorder, a skin disorder. What's interesting to note though is if you look at the company announcements, the bulk of the gains were made on the day that the company made that FDA announcement. Since then, you saw a bit of profit taking after that. The ASX top 200, one of the worst performers. Looking at the screen, we can see WiseTech shares clocked up one of the biggest falls, but year to date, they're up almost 56%. We think their shares still have plenty of upside given its growth and dominance in the software logistics space, as well as their growing profits, despite that short seller false allegation that we saw, which was another reason why its shares particularly have copped a lot of selling this month. Plus, don't forget Morgan Stanley, Macquarie and Citi, they all price in, and they're factually saying that WiseTech is now too cheap. Citi expects WiseTech shares to grow over $10 to $36.30. That's for WiseTech Global. So what's on the hot plate coming up? Well, firstly, in terms of markets, the US markets are expected to surge in the fourth quarter. And that's, of course, if you follow the history book. All three of the major US stock indices have traded positively 80% of the time since November 2009. Industrials, consumer discretionaries and materials typically have outperformed as well. The two major Aussie indices have traded positively as well 80% of the time over the last 10 years. And looking ahead to the horizon, what's on the cards for next week? Well, on Monday, retail sales are out for September and they're expected to slow again to 0.2%. The RBA governor has possibly opened the door to quantitative easing, and I'll explain what that means in just a sec. But he's opened the door to QE as monetary policy is not working exactly the same as it used to. And that's a quote that the RBA governor said earlier this week. But moving on, what's QE? Well, it's really where the central bank buys government securities from the market to boost money supply and encourage lending and investment. So if QE or quantitative easing happens, that remains to be seen. More closely to home, on Tuesday, Melbourne Cup, of course, the race that stops the nation, as well as the RBA interest rate decision, not expected to stop the nation as interest rates are expected to remain on hold. As we mentioned earlier, they're expected to remain on hold at 0.75%. On Tuesday, the services sector reading is out. We're expecting the services sector to slow from a reading of 51.5 to 51.3. It's still in expansionary phase though. That's the important message. On Thursday, trade surplus data is out for the September period, and that's expected to strengthen to $7.1 billion after it fell in the prior reading to $5.9 billion in August on the back of exports falling. Well, zooming back out, as we can see, conditions globally are slowing, but we're still ticking along and putting one foot in front of the other. So it's really important to look at tilting your portfolio towards those companies that outperform when the market is slowing or when the business cycle is slowing, just as it is now, and we're in the cycle phase called late cycle. So let's look at what's doing well and what will continue to do well. Well, physically backed assets such as companies like utilities and toll road operators and consumer staples like Coles, which Macquarie says is priced to grow, these companies typically look to outperform as they've done in the past. Looking at a toll road operator, let's say Transurban, for example, their company is growing earnings, revenue and dividends, and year to date Transurban shares have already clocked up 27%, and some analysts say their shares have still got room to grow. And that's it for me for October. Thanks so much for watching. Do take care, and thanks for tuning in.